Welcome to episode 6 of the Fun and Gain series, The Road to Your Financial Future. This one is entitled The Ragged Rock. It goes like this. And the ragged rock and the restless waters, waves wash over it. Fogs conceal it. On a halcyon day, it is merely a monument. In navigable weather, it is always a sea mark to lay a course by. But in the somber season, or the sudden fury, is what it always was. These are the words of T.S. Eliot in the poem The Dry Swages. There is no better description for risk, or at least for the human perception of and attitude toward risk. Now, Peter Bernstein is a well-known and esteemed economics and finance writer who died in 2009. And on the first pages of his introduction to Against the Gods, he calls the mastery of risk the revolutionary idea that defines the boundary between modern times and the past. Beginning with the discovery of the mathematical laws of chance, modern man has mastered risk, or so he contends. Sounds like a halcyon day to me. Surely the sudden financial fury struck in September 2008, the subprime mortgage crisis metastasized and brought down Lehman Brothers, Bear Stearns, and Merrill Lynch. It forced the government takeover of Fannie Mae and Freddie Mac. U.S. Treasury had to save AIG, Citigroup, Bank of America, and a host of smaller banks in order to prevent the total collapse of the entire financial system. Washington Mutual became the largest bank failure in U.S. history. We also saw the disappearance of Countrywide Credit, the largest mortgage company, and Wachovia Bank as an independent bank. And in this debacle, individual investors and pension funds lost an estimated $2 trillion of their retirement savings value. The entire global financial system foundered on the ragged rock, and risk was surely seen for what it always was. I doubt that we can legitimately claim to have mastered risk. Therefore, you will inevitably encounter more such sudden financial fury in your investment lifetime of 40 to 60 years. Such turbulent times creates fog. People tend to make all kinds of emotionally driven moves, often leading to a financial shipwreck. They suffer unrecoverable losses, dump stocks, or even completely stop investing for their future. As an investor, you need to build and outfit your financial ship to withstand the sudden fury and to get through with minimal damage. One thing about risk is that it's a creation of the human mind. It's not a physical thing. When it comes to risk, certainly waves wash over it and fogs conceal it. Risk is a perception, something that we can't see directly, if you will. We have to detect, derive, or conclude its presence in an indirect way. And these perceptions can change, as we have seen, quite suddenly. And Eliot's is a more poetic way of saying, as Burton Malkiel did, risk is a most slippery and elusive concept. I will add at this point that Malkiel also says, although there is general agreement that the compensation for higher risk must be greater future rewards and thus lower prices, measuring risk is well nigh impossible. So I will take a break from a lot of numbers, charts, and graphs in this episode. Risk does exist in spite of the fuzziness. Risk is one of John Bogle's controllable factors, but how do you control it if you can't really see it or measure it? I'm going to be so bold and amend Bogle's claim and say that you can control your exposure to risk. That is, you can control the risk you take, but you cannot control risk itself. In order to do this, though, you must first recognize risk and have some understanding of it. You cannot eliminate risk. Every investment has a risk factor and probably multiple risk factors. In a previous episode, episode 204 Tuna, I enumerated some of the risks described in the typical prospectus. Usually takes several pages of a prospectus. This is largely there to satisfy SEC requirements, but there is substance to it, and I wonder how many people really take the time to read and absorb what is in the prospectus. I can tell you that I used to look at the return data and look for the funds with the highest returns over the past 3 to 5 years. I didn't spend any time even reading the pages describing risk. And I have taken 2 or 3 episodes thus far to elaborate on rewards, and a prudent investor should take as much time reviewing the risks as in reviewing the rewards. So I want to talk more about risk in this episode. A better understanding of various risks will help you as an investor avoid problems in the first place, and will keep you from succumbing to panic from a sudden perception of risk, which is usually preceded by a sudden significant portfolio loss. In assessing any investment, the investor needs to run down the list of risks and think about how the risk categories might apply to the particular investment as well as to his or her particular situation. At the risk of being tedious, I want to quickly run through some of these risks in order to emphasize the complex nature of risk. Let's start with volatility risk, which is the extent to which returns vary. This is the most common concept of risk and is measured by the standard deviation. And I've talked a lot about this at some length in various previous episodes. And volatility can be a symptom of other types of risk as well. There is bubble risk, and this is the risk that many investors chase a certain asset class, drive prices way up, and then make it more prone to a sudden bust. And we saw this in the late 90s and into 2000 with the internet bubble that suddenly burst. We saw it again with the housing bubble that burst in 2006 and 2007. Leverage risk, which amplifies both gains and losses. Look at a mortgage as a clear example. If you put 10% down on a purchase and the price of your house increases by 10%, you just made 100% gain on your money. But if the opposite happens and the value drops 10%, you just lost all your money and you end up with a house that is worth less than the mortgage you are paying. And just consider all the foreclosures and short sales since 2008. Liquidity risk. This is the chance that an asset cannot be sold quickly at the prevailing price if you need to raise cash. And all too clearly, this risk emerged in 2008 with the so-called toxic assets. Everyone was fearful and the markets froze, so the U.S. Treasury and the Federal Reserve had to step in. Currency risk. We live certainly in a connected world these days, and shifts in relative values of currencies can have a significant effect, positive and negative, on dollar-based investments. Transparency risk. This is an important one. If the investment structure is too complex to understand, it's probably too risky. And we saw this again with toxic assets and credit derivatives that banks and other financial firms had on their books. Even the experts did not understand these risks. So sensitivity risk is the risk to the overall equity market and bond market. And this is related to correlation. Sometimes stock prices or bond prices go up or down just because other prices are moving. Think panic or think euphoria. And pretty much everything went down in September of 2008. Treasury bonds proved to be the only real safe haven. Event risk. This is the danger of an unforeseen event. This is Donald Rumsfeld's unknown unknown. It is often more like the earthquake, tsunami, and subsequent nuclear plant damage in Japan in March 2011. Everyone knew it was possible, but over time, since it hadn't happened, people began to act as if it wouldn't. Operational risk. This includes various risks of businesses failing to perform, and this is particularly the case with individual stocks. And it also applies to bonds, and if a company goes bust, the stock becomes worthless, and the bondholders may only get pennies on the dollar. It also applies to municipal bonds. If a source of revenue dries up, then the bonds can devalue. There is political risk. Government decisions can have a huge influence. Government indecisions can have a huge influence. And expect government decisions and non-decisions to play a larger role in the aftermath of our financial meltdown. And as example, in China, the government runs the banks. Brazil announced a 2% tax on investment money flowing into their country. In the U.S., we have major changes in banking laws. Market risk. This one's critical. Investor safeguards, rule of law, market transparency, public information availability, these are all parts of it. If you are investing overseas, particularly in emerging markets that have little in the way of these safeguards and investor protections, it's the overseas investors especially that can suffer. And potentially several risks can cascade. For example, volatility can lead to liquidity problems, which can in turn be amplified by excess leverage. There's also a risk factor inherent in your age and your career stage. I call this personal risk. If you're early to mid-career and your portfolio suffers losses, you have the time and the means to recover. If you're close to retirement, limited future earning power, the even normal volatility of stocks can pose a serious threat. Burton Malkiel makes the point that there's a difference between your attitude toward risk and your capacity for risk. Generally speaking, your capacity for risk is inversely proportional to your age. Actually, this cuts both ways. Some investors are far too conservative in the early stages of their careers and allocate too much money to money market funds and low-growth bond funds. Others, as they approach retirement, have too high a percentage of their retirement assets committed to stock funds. I've said several times that risk and reward are linked. This is the theory anyway. And Jeremy Siegel, professor at MIT, echoes Burton Malkiel and John Bogle. He says in his famous book, Stocks for the Long Run, risk and return are the building blocks of finance and portfolio management. So just how does this linkage work? Modern portfolio theory, or MPT as it is commonly called, first articulated by Harry Markowitz in his doctoral dissertation in 1952, provides an elegant view of this linkage. In its simple form, it says that you can set the reward and then have to accept the associated risk, or you can set the risk and have to accept the reward for that level of risk. So in essence, if you want higher returns, you get higher risk, and if you want lower risk, you get lower returns. The trade-off comes along a curve called the efficient frontier. And along this curve, you cannot find an asset mix that offers a higher return without accepting higher risk. And conversely, you cannot lower your risk without also lowering your return. There is one point, the optimum, which is called, or point of minimum risk on this curve. Now, some key assumptions about returns, which, as I noted before, are essentially price changes, underlie modern portfolio theory. These assumptions are often unrecognized or ignored by individual investors, and that is where a problem can start. These assumptions are highly suspect, to say the least. Number one, each return is assumed to be independent. That is, a return from yesterday or a year ago does not influence the return today. Number two, the process generating returns, whatever it is, does not change. And number three, returns follow the proportions of the bell curve. That is, most returns measured as positive or negative changes are small, and very large changes have a very, very low probability. The beauty of this model in financial theory is that you only need two numbers to make the model work: the average return and the volatility. To compute the efficient frontier, you need these and the correlation matrix. And using historical data, you can compute all this. And assuming that the data follows the bell curve, you can then compute the probabilities of various losses or gains and, in essence, predict your risk-reward relationship. It is then a matter of personal preference where you choose to position yourself on the efficient frontier. This is called investor risk tolerance. And the brokerage firms have all kinds of elaborate questionnaires for you to assess your own risk tolerance. All this creates a sense that you can measure the immeasurable. I read Nassim Nicholas Taleb's book, The Black Swan. It is subtitled, The Impact of the Highly Improbable. Taleb has a chapter called The Bell Curve, That Great Intellectual Fraud. And he says, and I quote, "Shockingly, the bell curve is used as a risk measurement tool by those regulators and central bankers who wear dark suits and talk in a boring way about currencies." He says that the main point of the bell curve, also called the Gaussian curve, is that most observations hover around the mediocre, the average. The odds of a deviation decline faster and faster, that is exponentially, as you move away from the average. And later he goes on to say, measures of uncertainty that are based on the bell curve simply disregard the possibility and the impact of sharp jumps or discontinuities. And although unpredictable large deviations are rare, they cannot be dismissed as outliers because cumulatively their impact is so dramatic. All I can say is, amen, brother. Now, one mathematician that Taleb has high regard for is Benoit Mandelbrot, who just died recently in 2011. And he references a recent book by Mandelbrot, The Misbehavior of Markets, which he wrote and co-authored with Rick Hudson. The ideas are definitely Mandelbrot's, and I think Hudson helps make the concepts understandable. Mandelbrot is most famous for the discovery of fractals and fractal geometry. I ordered this book. It is an interesting read and really contains surprisingly little math. Mandelbrot favors a visual approach that uses a lot of graphs and charts and things like that. And as it turns out, he has been a longtime student of pricing and market theory. With his studies of cotton pricing in the early 1960s, Mandelbrot shook up the economics establishment for a short time. His findings were never refuted but merely ignored, and so the orthodox thinking continued to dominate. And one big issue with Mandelbrot is the measurement of risk. Now, he points out that one of the key ideas of modern finance is that through the use of laws of chance, risk can be measured and managed. And Mandelbrot doesn't really argue with using the laws of chance to model financial markets. He just disputes the theorist's use of the bell curve as that model. He uses daily price changes to make his point. And using the Gaussian formula for the bell curve, Mandelbrot calculates the probability of 3 successive daily declines of 3.5%, 4.4%, and 6.8% in the Dow Jones Industrial Average in August 1998, which, by the way, is fairly recent history. Mandelbrot calculates odds of the 6.8% decline at 1 in 20 million, and he adds that if you trade daily, it still wouldn't happen once in 100,000 years. The odds of getting 3 such declines in 1 month are about 1 in 50 billion. He then calculates the odds of the October 19th, 1997 crash at less than 1 in 10 to the 50th. Now that's a number so small it is beyond imagination. So you have to agree with Mandelbrot when he says the seemingly improbable happens all the time in financial markets. At one point, last point from Taleb, he says, in the last 50 years, the 10 most extreme days in the financial markets represent half the returns. So on the positive side of the curve, as well as on the negative, highly improbable, according to the bell curve model, events have a huge impact. Now, Jeremy Siegel, the professor at MIT that I just referred to, reminds us that one can never be certain that the underlying factors that generate asset prices have remained unchanged. One cannot, as in the physical sciences, run repeated controlled experiments. Because of the changing nature of risk over time, portfolio allocations depend crucially on the investor's planning horizon. So you must always be attentive to risks and continuously examine your assumptions. I see a huge disconnect between the theory and the empirical reality. But you know that the difference between theory and reality is that in theory there is no difference. The consequences are dangerous. Mandelbrot goes on to say that the odds of financial ruin in a free global market economy have been grossly underestimated. The meltdown of September 2008 certainly gives credence to that statement. And the great economist John Maynard Keynes said that all models are wrong, but some models are useful, something close to that. So the question is, can you use MPT, modern portfolio theory, and the bell curve to model or construct an effective portfolio model for your retirement? It looks to me like the answer is not really. Okay, so now what are we supposed to do? And I think that as retirement investors, we have a very big problem. How are we going to tease out and assess all the risk factors that I've been talking about? I don't think I can do that, and based on 2008, I'm not sure anybody is really capable of it. So I would rather rely on seasoned investors and practical traders who have long experience. This includes John Bogle and Burton Malkiel, whom I have mentioned frequently. Another example is David Swensen, the head of Yale University's endowment. He's a legend in his own time. In over 25 years of steady, exceptional performance, he has become hugely influential on Wall Street, and especially within the endowment and public funds community. In an interview in the Financial Times in October of 2009, he offered some key investing advice to retirement investors. You should invest only in things that you understand. That should be the starting point and the finishing point. The overwhelming number of investors, individual and institutional, should be completely in low-cost index funds because that's easy to understand. And I think that is very sound advice. The big message in all this is that you have to pay attention to risk. You must assess your risk exposure as a critical part of your investment decision-making process. You have to build your financial ship to withstand the sudden fury and the somber season. I'll try to boil this discussion down to individual investment policy implications. Understand not only the potential rewards, but especially the risks of your investments. For every investment decision, ask yourself what the risks are. Do not rely solely on standard deviation and theoretical models to adequately assess risk and establish your risk exposure. Gauge and set your risk level based on your capacity for risk, namely your age and proximity to retirement, when setting your asset allocations. Heed the advice of seasoned investors who have proven themselves both on the halcyon day and in the sudden fury. Utilize index funds as your primary means to invest for your future. Let me add a final footnote. 401k plans are generally biased towards stocks, and many are deficient, at least they were in my day, in asset classes that can help you build your retirement ship strongly enough to withstand the sudden fury. Other investment vehicles like IRA accounts and even taxable accounts can help you achieve the right balance. Take this into account in developing your investment policy and in building your retirement portfolio. This finishes episode 6. In the next episode, titled, What'd I Say?, I'm going to review and organize the investment policy elements covered in the episodes thus far. I'll see you then.